Breaking! All eyes were on the Bank of Canada this morning as it was set to make its interest rate announcement, with most expecting a 25 basis point rate cut, but some going as far as to argue we'd be seeing a 50 basis point cut coming from the central bank.
I guarantee it.
We got our answer this morning when the bank did indeed cut by 25 basis points.
Yes, shocking.
And Bank of Canada Governor Tiff Macklem and Deputy Governor Carolyn Rogers discussed that rate cut at its press conference held shortly after the announcement, where Canada's financial media elite did their best to keep up with the governor.
Why 25 and why not 50? I mean, what is stopping you from being aggressive?
No, but seriously though, although we did see a few rate cut questions bringing the total for the year up to 29, we did see a few real substantive questions coming from Canada's media, including questions about Canadian debt levels, inflationary risks, and overnight repo operations. So what I want to do today is go over the Bank of Canada's announcement, take a look at the press conference held shortly thereafter, and then discuss some implications. As we'll see today, how far the Bank of Canada goes in its rate-cutting cycle will be largely dependent on its economy and its inflation rate, both of which we'll continue to track on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this rate announcement. Onto the announcement. As mentioned, the Bank of Canada cut rates again by 25 basis points this morning, bringing the policy rate down to 4.25, its lowest point since December of 2022.
The worst is over.
The bank noted that the weakening economy continues to put downward pressure on inflation, even though shelter and some services continue to put upward pressure on the CPI. With that said, although the bank notes that inflation is coming down, it warned that it could be appearing to bump back up later in the year, as base effects make the year-over-year data look like inflation is moving higher. So, while some prices, such as gas, were abnormally low last November, when this November comes around, it's going to look like inflation is moving up higher once again. And the bank has been warning about this for some time, mentioning it in its July announcement as well. And on this, the fact that the bank is continually warning about these base year effects, warning about them 5 months early, tells me that we have a central bank very cognizant of its credibility problem, that it doesn't want Canadians seeing the bank drop rates, see inflation appear to be ticking back up come the winter months, and then think, here we go again.
It's not going to happen again.
With that said, the bank did note that, yeah, it could happen again. So, the bank has cut rates by another 25 basis points, bringing the policy rate down to 4.25 as it continues to see the economy weaken, though it is warning that in the coming months inflation could look higher than it actually is, and that inflation could in fact go higher. And the governor addressed the 25 basis point cut, of course, on the first question of the press conference. Why didn't the bank cut more?
I'm wondering if anybody around the table argued for a half-point rate cut, or whether that was something that you debated.
And although the governor didn't really answer the question, he did note that the Governing Council discussed two potential alternative scenarios. One, the slowing of rate cuts if we get an upward inflationary surprise, and two, the speeding up of rate cuts if the economy continues to weaken faster.
We did discuss, looking forward, we did discuss some different scenarios where it might be appropriate to slow the pace of declines in interest rates. We also discussed scenarios where it could be appropriate to cut by 50 basis points. So
the bank is not currently discussing a 50 basis point rate cut, though it could if the economy continues to weaken. But it also could go the other way, which is going to be important in a few minutes. And then, of course, the question directly following that of the first, the exact same question.
Unemployment is very high. It's like 30-month high. Inflation is a 40-month low. At this stage, why 25 and why not 50? I mean, what is stopping you from being aggressive?
And then, of course, the governor didn't really answer the question, as he had just sort of answered.
Getting back to what I just said to Najoud, we will be assessing the data as it comes out, and if we need to take a bigger step, we're prepared to take a bigger step. At this point, 25 basis points looked appropriate.
Moving on, the governor was then asked what we've been talking about so much on this channel. The Bank of Canada cutting rates in order to induce Canadians to spend, induce Canadians to borrow, when Canadian debt levels are already at near record highs.
How worried are you about sending a signal to Canadians about taking on too much debt as they see the interest rates start to drop?
Well, really now you're...
That took a bit longer than it should have, and we're about to see why.
I mean, the reality is household debt in Canada is quite high. And, that's one reason why when households hold more debt...
Yeah, whoops. My guess is, and I can't confirm this as of yet, the governor does not return my phone calls, but my guess is the governor was about to say the reason the Bank of Canada cut rates was to help Canadians who are overburdened with debt, to save the economy by lowering rates for those over-indebted Canadians. But that's not going to play very well for the public.
I do know some things.
And then the governor said as much.
But it has been important to take the steam out of inflation. That has worked. Inflation has come down. We're getting close to the target. And that's been reflected in our decisions to lower interest rates. That will reduce some of the pressure. I mean, if you've got a variable rate mortgage, you're already seeing some relief in terms of your monthly payments. If you're renewing your mortgage, obviously, lower interest rate, you're still going to have a positive reset if you took your mortgage out when interest rates were at extremely low levels, but it won't be as big.
Yeah, on the one hand, that's a good point. Say you bought the benchmark price home at the peak of the pandemic in February of 2022, priced at $834,000, put 20% down, and got a decent variable rate mortgage from RBC at prime minus 0.75. You've seen your payment rise from $2,700 in February of 2022 up to $4,450 when the bank hit its peak interest rate, but have now, with 3 cuts under the Bank of Canada's belt, seen that payment drop to $4,150. So that payment is up about $1,400 since the time you bought the home, but down $300 since the bank started cutting rates.
See, I told you it'd work out.
But on the other hand, the governor didn't really answer the reporter's question in that, essentially, the Bank of Canada, by lowering rates, is inducing Canadians to borrow more money at a time when we're already in record levels of debt. With that said, it doesn't appear, at least, as though the governor thinks Canadians are about to pile into more debt, as evidenced when the governor was asked about potential inflationary risks.
And you said today that upward pressures on inflation could be stronger than expected. Can you just expand on what those concerns are, apart from the base year effects unwinding at the end of this year?
And on this, the governor turned to shelter price inflation.
We need to see some easing in shelter price inflation. I mean, shelter is like 25% of the average Canadian consumer's spending basket. It's a big part of what Canadians spend their money on, and it's running over 8%. So it's going to be very hard to get to 2% inflation when a quarter of your basket, a necessity, is running that high. So we're going to need to see some further easing. That, it is, there is a risk that shelter price inflation doesn't ease or even strengthens. We're not predicting that. That's not our base case. But when you're talking about risks, what could hold inflation up, that's certainly something that could hold it up.
So the Bank of Canada is keeping a close eye on shelter inflation, has recognized that if house prices shoot back up on lower interest rates, that would put overall pressure on our CPI. Remember that when the economic oracles on TikTok tell you that rates are going to zero, and the bank is going to let house prices get back to their pandemic peaks. And finally, the governor was asked about the overnight repo operations that it's been conducting since July, which we've discussed on this channel, which have been reaching nearly $16 billion per day.
Can you give us an update on where you see the steady-state level of settlement balances for the payment system, given the ongoing maintenance in overnight markets to keep core closer to target? Has the bank changed its views on the level of reserve?
On this, Deputy Governor Rogers chose to answer, deferring to a report published by the central bank last month.
Yeah, we can give you an update, Randy, that we don't see much change in the target we have for settlement balances. I think we're hovering around 100 million still, and we still think we'll get somewhere closer to, we've given a range, but somewhere below 80. So we've got a ways to go. The pressure that we've seen in the overnight market, we don't see that as related to the level of settlement balances. I gave you a bit of an update at the July press conference on this, and since then we published a really good, really technical, but really good explanation that our staff have done on where we think the source of that pressure in the overnight market is, and why, specifically why we don't see it as related to our quantitative tightening or to our reduction in the overall settlement balances in the market.
And yeah, we covered this highly technical report on this channel. Long story short, the report noted that it wasn't so much a lack of funds in the system causing the Bank of Canada to have to intervene, but rather more hedge funds borrowing in the overnight repo market, sending the repo rate higher. So that does appear to be the position of the central bank, meaning we shouldn't expect quantitative tightening to end anytime soon, with there still being over $100 billion sitting in reserve in the accounts of the big banks at the Bank of Canada. With that said, as we discussed on this channel when we went over that report, demand does not occur in a vacuum. It is a function of supply.
Really?
So if the repo rate is spiking because hedge funds are borrowing in the overnight repo market, obviously, there is not enough supply of funds to handle that demand. Regardless of the technical aspects, though, the bank is maintaining that position, so for our purposes, wanting to understand where inflation, where interest rates are heading, it doesn't look like the bank is going to be ending quantitative tightening anytime soon. So, in summary, the bank has lowered rates yet again. It does see a weakening economy going forward, a weakening economy continuing to put downward pressure on inflation. However, there are risks to the inflation rate, as the Bank of Canada has recognized, mainly due to house prices, mainly due to shelter inflation, which the bank is keeping a close eye on. Contrary to the popular opinion amongst an unpopular profession, the bank rate cuts do not occur in a vacuum. It's not like they just put rates to zero and completely forget about the housing market. Again, whether or not these rate cuts will lead to a reignition of house prices remains to be seen, but we will obviously continue to track Canada's economy and Canada's real estate market on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.